Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. All right, the big question is, are we headed for a bull market in 2023? I think there's a good argument for both sides of this debate. And as investors, this is what we're talking about, especially as we end 2022 and try to prepare our portfolios for next year. So I wanted to ask Jon Quast what his thoughts were. Jon, thanks for joining us.
You bet, Travis. Glad to be here.
All right, before we get into that, please subscribe to Rive Investing. I really appreciate it. It helps support the show, and share this with anybody else who would be interested in sort of our outlook for 2023. And I think we're going to have a pretty good debate about what the economic conditions are going to look like, and then how that translates to the market as well. So, Jon, I want to throw it to you because I think you've got some good data to make an argument that maybe things aren't going to be great in 2023. So where do you want to start?
Yeah, there are four basic things that I'm looking at, Travis, that I think are going to lead to harder economic conditions in 2023 and possibly even an ongoing bear market then as a result from these four different conditions. And so first up would be housing. Housing is something that I see as a dark cloud on the economy. And specifically, if we look at pending home sales data, this is the most recent data for pending home sales in October. It came out in November, but the data is for October. We're still waiting on the November data. This is showing a 37% year-over-year decline. That's the steepest decline on record according to the Association of Realtors. And so that means something when you have the largest decline ever on record. So why is this happening? Why are all of a sudden people failing to buy new houses? Well, interest rates have a big thing to do with it. And so you have two things going on here. First, we have the factor that home prices are objectively high. They're up incredibly over the last 2 years.
By almost any measure.
It doesn't matter where you are. You can look at the Case-Shiller index, for example. That is kind of a standard way to think about home prices. It adjusts for a lot of things. It normalizes for a lot of things, still objectively much higher than where it should be under normal conditions. And so you have high home prices to start with, and now you have interest rates going up, which reduces what people are able to pay for a house. And this is actually by design. So we see here, going back to what the Federal Reserve was saying here recently on some of their rationale for why they are raising rates, is so that there can be a correction in the housing market. Specifically saying, this is too high. Houses aren't affordable. This is a bubble. We're going to have to go through a difficult correction, but it needs to be done. So that's part of the rationale why they're raising interest rates to begin with. They are trying to bring those prices down. What does this do? For over 10 years now, the interest rates are now higher than where they've been over the past decade. But over the past decade, the interest rates have come down. People have been able to refinance. That does two things. You're able to tap the equity in your home. When you do that, potentially spending it, building an addition to your house, buying a boat.
To buy stuff. Yep.
Yeah, putting in a pool.
Yep.
It also brings down your monthly payment. And so now you have more disposable income on a regular basis. Anyone who has bought a home in the past 12 years, now if they went to refinance their home, would have a higher interest rate than what they have right now. So they're not going to be doing that. So that's not unlocking new capital into the system. That is something that I see the housing market bringing that, weight on the economy, but I also see the double effect here of people being left with less disposable income as a result of housing prices coming down and interest rates going up.
So I want to hang on this for just a second, because I think this is really interesting data. And I think what you said right there is something that is probably going to happen, but is really hard to tease out. The increased liquidity over the last 40 years is something that you can pull out value from your home and spend it, whether it's on a car or a vacation or, like you said, addition to your home. But there is that liquidity available, and now we're kind of going in the opposite direction. So the Federal Reserve not only is sucking liquidity from the market by not buying as many bonds as it once was, but the housing market has less liquidity because people aren't able to refinance and pull money out. The counter to that would be that the housing market is very sticky. And so, like, let's take me as an example. We bought our home in 2018. We refinanced in 2020. So, we're locked at 2.8% or something like that. We're not going anywhere for a very long time. And not that we were going to, but if interest rates go up and you now can't afford a home that's bigger, which is, upgrade your home, start with a starter home, then get a little bigger home when you get a family. And then, that was always kind of the thing you did for the last 40 years. Well, maybe that's not possible for the next 10 years. So people just stay in the home that they're in longer. It isn't like those homes don't exist. So I just want to kind of, the impact on the economy can be sort of strange, because it's like I feel a little less wealthy because I have less of this liquidity in my pocket, but I still have a house. I'm just going to maybe stay here a little longer than I would have preferred to, or than I planned to. So how do you think about that? Because I think this is one of those complicated discussions where you could sort of use the same data to make the exact same argument on two sides of things.
Yeah, it's to your point, there have been many things over the course of history, but even over the course of the last 100 years, where to look at where we got and look at what the first domino was that started that chain reaction, you never would have predicted that would have come about. So who would have thought that, the end of World War II, a bunch of people coming home would all of a sudden be this amazing boom for the economy and for wages and all the things that came out from that. Who would have thought that 2001, what happened, would then all of a sudden spiral into a student loan crisis? Right, so the war on terror, and all of a sudden a student loan crisis bubbles out of it, and you can trace direct cause and effect throughout that entire process. So to your point, yes, it's well taken. This is what is happening. What then is the effect from those causes? We don't really know yet, and it's hard to predict that with any sort of certainty. So to your point, yeah, there could be a very different outcome from the whole housing market situation.
You brought some interesting data about the used car market, because I think one of my arguments here would be the housing market is sort of strange because people can just stay longer than they normally would. It's not the same liquidity market as the stock market, where there's literally a price every day and you have to you have to sort of mark to that data. The car market's very different because we do switch cars much more often. And there are loans out there that may now be underwater on vehicles that have dropped significantly in value. So talk a little bit about this and what the impact might be, because I think this is just shocking data when you start looking at it.
It's absolutely shocking. So this is called the Manheim Used Car Index, and you don't need to understand exactly how it works to understand that down there at the bottom at around 100, that's kind of what's considered normal for this index. And so you can see that there was a gradual rise in used car prices over the past decade. What that reflects is an interest rate that was steadily going down. And so as interest rates go down, people can take out a bigger loan, afford more car. And so naturally, there is kind of a cause and effect there with used car prices. Used car prices start to trend upwards as there is more demand for these higher end cars. And so then all of a sudden in 2020, what happens? There is no inventory available in used cars and prices go through the roof. Absolutely unprecedented increase in used car prices as bore out here. Yes, over double. We've started to see that this is a bubble. And I don't use that word lightly. I know that is kind of a scary word and it does get overused. However, I think that it's very appropriate in this case to say that used car prices were in a bubble. It was about a supply issue and demand as well. Demand was high. People had more disposable income, especially in the early days of the pandemic, thanks to government stimulus. And so we saw this bubble develop. It's starting to come back down now, but it still has a long ways to go before we hit normal. Here's something that could exacerbate this problem. The fact that CarMax and Carvana, two of the biggest auto retailers in the country, they're sitting on record high inventory, specifically, particularly Carvana. And so what has actually happened over the past couple of years is that Carvana's goal was to sell as many cars as they possibly could, and they had to get inventory any way possible. And so they were willing to pay over Blue Book value, over what would be considered the real value of that used car. They were willing to pay over that price and then turn around and sell it for an even higher price still. Now they're sitting on a bunch of inventory that is going down in value. There is some anecdotal evidence out there that they're starting to offer some of this inventory back to wholesalers in the used car space, trying to offload some of this inventory, but it doesn't seem like it's working. They're developing into a real liquidity crunch for this company. People aren't willing to buy used cars right now because they see that they're going down in price. The company is stuck holding the bag, if you will, and not only that, interest rates are still going up, and so people can afford less and less. So this is kind of another problem that is brewing under the surface of the economy, and one that, you know, I do see this as something that could definitely have major ramifications across many different things, and what exactly it all will mean as it shakes out, I don't know, but I think that used car prices are heading lower, and I think that used car dealers are kind of in trouble.
Yeah, and this is another one of those things where the downstream impact is maybe bigger than we think, because this involves aluminum and steel. It involves chips. If used car demand goes down, new cars demand is going to go down. There's just a lot of pieces that go into it. This is a very large purchase that people are making, and so it's a huge chunk of the economy is the auto industry, and so that would be I think a good argument that there's a lot of downstream effects that. Now, on the flip side of that, we have been in an undersupplied market for new vehicles for 3 years now, about 3 years. So could we see production of new vehicles come up to sort of meet demand? The impact is lower values for used vehicles. Maybe it's kind of like one side wins, the other side loses, but you kind of come out in the wash from an economic perspective. That would be the bullish scenario, I think, but you got to kind of squint a little bit to see that right now.
Indeed. Okay, so third up here, I'm looking at jobs, and specifically with jobs, the decisions that the Federal Reserve and other policymakers have been making based on assumptions. And so the assumptions here, for example, in the second quarter, the assumption was that the economy added over 1.1 net new jobs. Okay, that was what the original estimate was, and it is reasonable to assume that that estimate would be wrong. It is reasonable to assume a margin of error, 5%, 10%. It's going to be wrong. However, this was astronomically wrong. The more recent data coming out from the Federal Bank of Philadelphia saying that only 10,000 net new jobs in the second quarter, as opposed to over 1.1 million. So they're off by 1.1 million in their calculation here. My only point with that is and you can debate whether the jobs market is still strong, not whether there's more unemployed, less unemployed. That's not my point here. My point here is that one of the key reasons that they're making the decisions that they are for a soft landing in the economy is based on what they saw with the jobs. And that is guiding the policy right now. And it turns out, hey, our data was actually really, really wrong. What does that do for the so-called soft landing in 2023? I think that there's a good chance that they have overcorrected in raising the interest rates, in trying to slow this whole economy down based on what they were seeing in jobs, which turned out not to be true. I think that they probably overcorrected here. So I think it's going to be a little bit harsher in 2023 than what the Federal Reserve is expecting.
Okay, can I try to frame that in a very simple manner? Because I think what you're saying is sort of complicated. You're saying that basically the Federal Reserve raised rates in the intention of slowing down the economy that was overheating. There was too much inflation. The jobs market was too strong. It's always weird to say that, like too many people have jobs and they're demanding too much money.
Exactly.
But the jobs market was too strong. And so to slow things down, they raised interest rates, but they raised them too high. And when you raise them too high, then you slow down car sales, you slow down house building and all home sales, you slow down credit card purchases, you slow down everything, and kind of maybe there was, to go back to this word that was a hot word last year, transitory inflation, sort of one-time inflation coming out of the pandemic because of the pandemic. And that was a big driver of inflation. And now that they're correcting, thinking that that inflation was core inflation or like here to stay inflation, that they've kind of thrown the baby out with the bathwater. They're going to hurt the economy in the intention of slowing inflation and go too far. And maybe now I know that I've seen worries that we're going to be in a deflationary environment, which would mean that the Fed is going to have to come back sometime next year and like lower interest rates just to try to stimulate the economy. Is that sort of the complicated? You're almost saying interest rates are going to come down, which would be bullish for the market, but they're going to come down because of how bad the economy gets. Am I understanding that correctly?
Absolutely. I would say that the Fed is saying here that they're trying to turn around a very sharp corner, and they're saying that they're going to stay on the road. They're going to stay in the lane as they turn this sharp corner. Actually, they're not going in the ditch, but they're going to hit that little rumble strip on the side of the road. They're kind of getting out of the lane here because they've steered too hard in trying to go around this corner based on the faulty data that they got.
I think that all makes a lot of sense. I want to take a little bit more of a bullish angle on the market. One of the things that I think everything that you're saying is correct. I also think that the market is a forward-looking mechanism. So if we're talking about are we going to be in for a bull market in the stock market in 2023? What is the market going to be thinking about in December 2023 compared to what we're thinking about today? So you're right. Today we're worried about home values. We're worried about used car defaults. We're worried about all kinds of inflation, how high are interest rates going, all this stuff. Worry, worry, worry. 2023, we're going to know the answer to a lot of those things. And so there's going to be a lot less uncertainty. Investors don't like uncertainty. Valuations typically go down when uncertainty is high. So I think that we've flushed a lot of that negative stuff out of the system. I want to give a few things that I'm very bullish on for 2023. China is reopening. China is the world's second largest economy. They have been under varying levels of zero COVID restrictions over the last 3 years. They appear to be completely reversing that and moving towards opening up fairly soon. In the next 6 months for sure are the early indications right now. So that's bullish from an economy standpoint. There's going to be a lot of pain and dislocations that happen because of the way that they're opening up. But I think from an economic activity standpoint, from a supply standpoint, from a demand in China standpoint, that's going to be very bullish for the global economy. The fundamentals of the U.S. economy look fairly strong. I think one of the things that's really interesting is I've been talking about this as a coastal recession. If you look at the jobs where there are major layoffs right now, it's in places like San Francisco. I live in Minnesota. I looked at I believe our unemployment rate is lower than it's ever been right now. And I looked at where there have been mass layoffs. The companies have to report to the state if they're going to lay off over a certain number of people. There was one small company last month. There was another small company the month before. But the just sort of regular course of business things, the businesses that operate here, and in the Minneapolis area, there are more Fortune 500 companies than any other city in the country. So, we should be a pretty good proxy here, and things are going pretty well. So I think, this could be a case where the media centers are doing fairly poorly because, tech is getting hit hard, finance is getting hit hard. But the middle of the country where we're doing things like manufacturing and producing oil, making lumber, things are going pretty well. And by the way, that's where the vast majority of the people in the country live, is in the middle 80 or 90% of the country. So I think that's pretty bullish from a fundamental perspective. The theme here is I think that a lot of the most pain is behind us. When a bubble bursts, there's a lot of you never know what the dislocations are going to be and what the answer is going to be. I think that we've seen the bubble burst in technology in a lot of ways. There may be further for some companies to fall. Maybe some companies have already hit their bottom. But now we're moving back to, hey, who's making money? Who's actually generating a return on investment? And that's where money has flowed in the market recently. I think that's a good thing. And so I think we're in for a pretty solid year. And, China is a big piece of that because they're going to be a demand source for the globe. Maybe that leads to other things like a return of inflation, because now suddenly China's economy is back again. But yeah, I take everything that you're saying, and I think that's all correct. And it can be sort of a weird dislocation in the housing market. Maybe people stay in their homes longer. Maybe people keep their cars a little longer. But the economy can still be functioning fairly well. And by the end of 2023, I think we're going to be higher than we are today. And I think there's a lot of companies that are really undervalued right now that are going to do really well. So what do you want to leave us with your final thoughts here, Jon?
To agree with you, and this is actually something I planned to say from the beginning, is that while I do remain bearish in my outlook for the entire market in 2023, I'm actually quite bullish on many individual stock opportunities. And this is something that is not uncommon. In fact, it is normal, is that the average can do one thing and individual stocks can do other things. So you just look at this year, the S&P 500 is down, 15%, more than 10. Occidental Petroleum is up over 100%, right? So there was opportunities even in a bear market. And I maintain that outlook for 2023 to go along perfectly with what you're saying. Yes, I can be bearish on the entire outlook, but there are some really, really interesting things going on here. You look at a company like PayPal from a price to free cash flow perspective, it's never been this cheap. You look at something like Match Group that has been completely thrown out in 2022. All of a sudden, there's a new CEO in town who's developing more add-on monetization streams to what is already a very sticky business. That stock to me looks a lot better for 2023. So I think there is individual opportunities. If you can detach that and say, yes, it's going to be fewer perhaps opportunities in the coming year than what I'm used to, but I think that really does favor a stock picker, is that you can sit down and say, you know what, not that one, not that one. This one is where I am investing for the coming year and beyond.
Yeah, I think that's right. And in 2023, I wouldn't be surprised if we see a lot of companies really start to rationalize what their business looks like too. Over the last decade, you could have focused solely on growth and done really, really well as a CEO or as a founder. This next year, it's going to be interesting to see how companies adapt. Maybe Twitter was a canary in the coal mine because they went in and cut 75% of staff. And if the site doesn't go down and, eventually things come back and they improve their business model, are there companies like Alphabet and Meta who go, goodness, can we cut 50% of our staff? That's rough to say, but that's not only where we're going to see higher earnings, but we're also long-term going to see more innovation, because that will push a lot of the people who are working at these companies to found new startups and do new interesting things. I think that's another potential economic benefit that will be, a decade in the making. So, it will be interesting to see which companies decide to go the route of, hey, we need to get really lean really quickly. I think, Alphabet's one that probably could, but probably doesn't need to. Meta is going to be the one that I'm watching. I think you could easily make the argument if they just cut their entire Reality Labs business and say, hey, this was a failed experiment, I think their stock would double. And I don't think that Mark Zuckerberg is going to do that, but there's a company that how much pressure comes on them. And, take any other tech stock in that same vein. Not only can we cut our expenses, but can we increase our prices? It's a private company, but Gumroad did this recently, and I think that their prices effectively went up like 3x, 2 to 3x, depending on what tier you were on. This impacts creators, but if you're that company and you're burning through cash and you're looking at the market and going, hey, there's no way for me to raise funds in the next year, so I need to get to profitability really quickly. How do I do that? I only got two levers. I got revenue and I got costs, and so. Who's going to be able to make that transition? That's going to be really interesting to see. I'm bullish for the year because I think this last year has put a lot of pressure on companies that needed the pressure. and we're going to come, just like 2008 and 2009, we're going to come out of this stronger. Look, I bought some stocks in March of 2009 because it was like, how bad can this get? Like, is the world just going to end? We're not maybe quite at that point, but sometime in the next few months, 6 months, maybe we're gonna bottom. We're gonna hit max pain, and that's when you start to get really great investing opportunities. So that's why I'm bullish on the year. Well, thank you, Jon, for joining me. Feel free to leave your comments in the comment section below. We would love to hear from you. Give this video a like, and of course, subscribe to Rive Investing. We really appreciate it. For Jon Quast, I'm Travis Hoium, and we will see you here again next time.